Okay, everyone, pause the doom scrolling for a sec. The Fed just dropped its first rate cut of the year, 25 basis points. And yes, people expected it. But here's what most reactions are missing. This move doesn't automatically mean mortgage rates are going to drop in a big way. In fact, right now, they're doing something a little more nuanced. Let's unpack what Jerome Powell said, what the dot plot updated, and what that really means, especially for folks looking to buy or refinance on a new home loan. So what happened? The Fed lowered the Fed funds rate to 4 to 4.25%, a quarter point cut, which is the first rate cut since December of last year. Markets had actually largely priced this cut in already, so this wasn't a huge surprise. But yields flickered, mortgage rates dropped somewhat ahead of the meeting yesterday, then ticked up a bit after Powell's press conference. And here is why. While the dot plot shows the Feds expect at least a couple more cuts this year, one of the plots was even pretty extreme, almost either 1.25 or 1.5%. But crucially, the forecasts are not a promise. Though some of them were showing some big cuts, Powell repeatedly emphasized that policy will be a meeting-by-meeting, data-dependent decision. We had a massive revision in the jobs reporting going all the way back to 2024 and being over 900,000 jobs less than previously reported. This actually is likely what led to the Fed taking action this meeting. However, Jerome Powell still isn't in love with where inflation is, and that's why he has been a little conservative when it came to promising anything. Powell called this a risk management cut, meaning the Fed is responding to slowing job growth, weakening labor market risk, all that other fun stuff, rather than celebrating inflation being under control. In fact, inflation actually is a little higher than where he wants to see it. One thing he stressed that long-term interest rates, which affect 30-year mortgages, are less under Fed control than short-term rates. Inflation expectations, term premium, global bond demand, even fiscal deficits all feed into long-term rates. Another subtle but big point, the Fed continues to let its balance sheet roll off, which we know as quantitative tightening. I've done a video on this previously. This puts upward pressure on long-term yields. They did not signal a reversal of quantitative tightening. So older mechanisms that were around that helped push mortgage rates down, which was qualitative easing, I've done a video on that as well, or buying long-duration treasuries and mortgage-backed securities, aren't being resurrected at this time, though I have seen some chatter online of some people in the industry speculating this may come to the table eventually. So what does this mean for mortgage rates going forward? Here's what most commentary is glossing over. Anticipation is already priced in. Mortgage rates had already started dropping before the Fed cut. If the bad news, i.e. signs of economic weakening, continues, rates could drop further, but most of the easy gains might already be taken. Rates moving down sharply will likely need qualitative easing or an aggressive change in QT. In other words, for long-term rates to move meaningfully lower, now think a 30-year fix down towards 5.5%, rather than, national average of 6 to 6.35 right now, the Fed would either need to slow or reverse quantitative tightening or possibly re-enter asset buying, which is qualitative easing. I know those words sound the same, just go with it. In some form or provide stronger guidance that stabilizes expectations. None of that was signaled explicitly today. Term premium and inflation expectations are now the wild cards. If inflation expectations creep up, so think tariffs, supply shocks, global pressures, or fiscal deficits scare bond investors, term premiums will rise and push mortgage rates up regardless of Fed cuts. We saw this last year when the Fed cut multiple times and mortgage rates actually reached their highest levels in quite some time immediately afterward. On the flip side, if inflation comes down faster than expected and labor markets softens cleanly without crisis, the Fed is more likely to cut more and serve as tailwinds for lower long-term rates. There is still meeting-by-meeting risk. Powell's emphasis is on not being on a preset path matters. Data matters. If we get stronger inflation or job market surprises, rate cuts might be delayed or worse, bond markets could push yields up in reaction. So for borrowers and agents out there, this isn't a we're home free moment. It's a watch closely and anticipate volatility moment. So what should you do if you're watching rates, buying, or refinancing? Lock when you can if you see a rate that makes sense for your long-term plan. Waiting for more cuts could cost you if yields creep upwards. We saw this all through last year. Don't lean too hard on forecasts. Track inflation and employment data. If jobs continue bleeding, that's more evidence the Fed will be forced to ease more. Keep an eye on fiscal policy, in particular if the Fed starts buying up mortgage-backed securities again, and global developments because they affect bond markets and those feed into your mortgage rate. For my realtors and partners that have made it this far, communicate that rates may drift, but the story is not guaranteed drop. Stop doing that. More that there's potential, but upside and downside are both still risk factors on the table. So yes, the Fed finally gave us a cut, but the question isn't, did they cut? It's what happens next. And from where I sit, the path to much lower mortgage rates isn't smooth. It requires some shifts in expectations, and most likely in policy tools we haven't seen yet, and a bunch of data breaking in just the right way. If you're building a plan around these moves, you need to be ready for surprises. That's all I've got today. You never know, something wild could happen and undo everything I just said. Feel free to reach out if you have a question about a scenario specific to you, and I will get you taken care of. Take care.